Dear students, Assalamu alaikum and hello to everyone. Let's start the remaining topics of investment appraisal. Let me first tell you what are the remaining topics, and then out of four remaining topics, we'll start the one, inshallah. Actually, in investment appraisal, the remaining topics are sensitivity analysis, second, lease or buy decision. Third one is asset replacement decision. Asset replacement decision. Fourth is capital rationing. So these are the four remaining topics. Out of these four remaining topics, let us start the first one, that is sensitivity analysis. Sensitivity analysis. Obviously, students, they really want to know what do you mean by sensitivity analysis? How do we perform sensitivity analysis? What is the importance of sensitivity analysis? Before answering all these questions, let me discuss few things. Number one, we know that one thing, if project is producing a positive NPV, then simply we accept the project. For example, if the NPV is positive 2 million, by looking at positive 2 million, we will simply decide that this project is financially acceptable because by investing in this project, company will have the positive NPV of 2 million, which will increase the wealth of the shareholders. That is why this project is acceptable. But the point is, this 2 million NPV is not the actual value. This is not the value which project has actually generated. Actually, this 2 million NPV is calculated by using estimates. All the variables which we have used in a project, all variables are estimates. An estimate can change also. So actually, sensitivity analysis gives us the information that how much adverse change in estimates will make NPV zero. Repeat. Actually, sensitivity analysis gives us the information how much adverse change in estimates will make NPV zero. The smaller the change makes NPV zero, the project is more riskier. For example, if the findings of sensitivity analysis gives you the information that if the selling price reduces by 2% and NPV becomes zero, and variable cost increases by 5% and NPV becomes zero, and let's say the fixed cost increases by 10%, then NPV will become zero. Then we will say that we have performed sensitivity analysis on 3 variables, but out of these 3 variables, this project is more riskier at selling price, because the the findings of sensitivity analysis, they tell us only the 2% decline, 2% reduction in the selling price will make NPV zero. So logically, 2% decline is obviously there's a very small change. So the logic is the lower change, adverse change, which makes NPV zero, project will be more riskier at that variable. So obviously, the reduction in the selling price by 2%, if NPV of this project will be zero, so we'll say that this project is more riskier at selling price as compared to other 2 variables. So simply, sensitivity gives us the information how much adverse change in the variable will make NPV zero. For example, how much reduction in the selling price will make NPV zero? How much increase in the variable cost will make NPV zero? How much increase in fixed cost will make NPV zero? Because all these are adverse changes. Reduction in the selling price is an adverse change. Increase in variable cost obviously is an adverse change. Increase in fixed cost is an adverse change too. Another thing, reduction in the sales volume. Obviously, how much reduction in the sales volume will make NPV zero? So reduction in the sale volume is also an adverse change. So basically, sensitivity analysis gives us the information how much adverse change in the variable will make NPV 0. Now listen and listen carefully. When it comes to sensitivity analysis, basically this technique is having obviously few limitations. So before we apply, how do we apply sensitivity analysis? Let us first discuss limitations in sensitivity analysis. And I think this is the first technique in which we are first discussing the limitations. Limitations in sensitivity analysis. Limitations in sensitivity analysis. So what are the limitations? Number one, actually, if you just concentrate on my example, I said how much reduction in the selling price will make NPV 0, how much increase in the variable cost, how much increase in the fixed cost, how much reduction in the sales volume. The first limitation, or you can say one of the limitations in sensitivity analysis is it is applicable only on one variable at a time and assumes all other variables are constant, obviously, which is not the case practically. Because if you are saying, let's say the selling price reduces by 2%, NPV becomes 0, or you are saying the selling price reduces by, let's say, 5%, NPV becomes 0, then the law of demand says if the selling price is going to be reduced, then sales volume should increase. So if the selling price is going to reduce, then why not sales volume? Why sales volume is not increasing? So that is a limitation in sensitivity analysis. Sensitivity analysis is applicable at a time only on one factor and it assumes all other factors are constant. So it is applicable. It is applicable only on one factor. You can say one variable at a time and assumes all other variables are constant. All other variables are constant. Obviously, this does not happen. Another thing, for example, if the sensitivity analysis findings, they tell you the selling price reduces by 5%, NPV becomes 0. For example, variable cost increases by 3%, NPV becomes 0. And let's say fixed cost increases by 20%, NPV becomes 0. Now you have the findings of the sensitivity analysis. Now the question is, after applying the sensitivity analysis and after knowing the results of sensitivity analysis, should we make investment or not? So simply sensitivity analysis does not give you any decision criteria. So the problem is, it is not giving us any decision criteria. Now the question is, what do you mean by decision criteria? It's very simple. If we are having one project in front of us, if that project produces positive NPV, we will accept the project. If it is producing negative NPV, we will reject the project. So that is called decision criteria. Another example, if there are 10 projects in front of you and you want to opt only one, so obviously out of 10, we will opt the project which gives us the highest NPV. That is also another example of decision criteria. But after applying sensitivity analysis and after knowing the results of the sensitivity analysis, should we make investment or not? Sensitivity does not tell you anything. It is up to the company, either they want to invest or not. So simply does not provide any decision criteria, does not provide any decision criteria. So it is actually not providing us any decision criteria. Now let us discuss how do we actually apply sensitivity analysis. As I mentioned just right now, it is applicable at a time only on one variable and assumes all other variables are constant. For example, if I'm applying sensitivity analysis on selling price, definitely if the selling price reduces, then NPV will become 0. Reduction in the selling price is an adverse event. How do we apply sensitivity? It's very simple. Sensitivity percentage is equal to NPV divided by present value of sales into 100. So you get the percentage. So how do we apply sensitivity analysis on the selling price? Simply NPV divided by present value of sales. And second, if I want to apply this on variable cost, obviously variable cost, if the variable cost increases, that is treated as an adverse event. So sensitivity percentage is equal to NPV divided by present value of variable cost. So definitely if the variable cost increases, and which makes NPV 0, so increase in variable cost is an adverse event. Third, fixed cost. Obviously rise in the fixed cost is an adverse event. So sensitivity percentage is equal to NPV divided by present value of fixed cost into 100. Sales volume. If the sales volume reduces, then obviously NPV becomes 0. Sales volume. So reduction in the sales volume is an adverse event. So sensitivity percentage is equal to NPV divided by present value of contribution. Okay. Now listen and listen carefully, a very important point. Dear students, if your NPV is after tax, then all the variables which are in denominator, they have to be after tax. Repeat, if the net present value is after tax, then all the denominators, which I've just written in different formulae, these variable will also be after tax. For example, look at the first one. If I'm applying sensitivity analysis on selling price, one, I know that reduction in the selling price is an adverse event. A very important point. If NPV is after tax, then present value of sales will also be after tax. If NPV is after tax, then present value variable cost will also be after tax. If NPV is after tax, then present value fixed cost will be after tax. If NPV is after tax, then present value of contribution will also be after tax. So the logic is, if your net present value is after tax, then all the variables, they will also be after tax. Fifth one, if examiner is asking you to apply sensitivity analysis, if your examiner is asking you to apply sensitivity analysis on cost of capital, so how do we apply? It's very, very simple. Cost of capital. Obviously, if the cost of capital rises, then NPV becomes 0. And for cost of capital, we know that if your cost of capital becomes equal to IRR, then NPV becomes 0. Because we did study IRR, and IRR actually is a discount rate which produces NPV 0. So how do we apply sensitivity percentage formula? Simply IRR minus cost of capital divided by cost of capital into 100. For example, if I just give you the example, for example, if project's IRR is, let's say, 17%, cost of capital is 10%. Cost of capital is 10%. An examiner is asking us to perform sensitivity analysis on cost of capital. Required sensitivity analysis on cost of capital, So one thing we know, that if the cost of capital becomes equal to IRR, then NPV becomes 0. Now, how to apply this formula of sensitivity IRR minus cost of capital divided by cost of capital is very simple. Sensitivity percentage is equal to IRR, which is 17%. So while putting in a formula, ignore the percentage sign, minus cost of capital, which is 10% divided by 10, then into 100. If you use the calculator, it becomes 70%. Simply 17 minus 10 gives you 7. 7 divided by 10, it is 0.7. Then multiply by 100, it's 70%. It means if the cost of capital increases by 70%, then NPV becomes 0. So the adverse changes rise in the cost of capital, and obviously if the cost of capital becomes equal to IRR, then NPV becomes 0. So how do we write? We'll simply write, if cost of capital increases by 70%, increases by 70%, then NPV will become zero. Will become zero. So simply whenever your examiner says perform sensitivity analysis on cost of capital, all you need to have the IRR. Simply IRR minus cost of capital divided by cost of capital, which gives you the sensitivity percentage. 6-1. If your examiner is asking you to apply sensitivity analysis on project's life, I've never ever seen that the examiner has ever asked perform sensitivity analysis on project life, but let's discuss. We are applying sensitivity analysis on project useful life. Now listen and listen carefully. If the project useful life reduces to discounted payback period, then NPV becomes zero. Logically, discounted payback period is the time period where NPV is zero. So if the project life reduces and it becomes equal to discounted payback period, then obviously NPV will be zero. So how do we apply sensitivity on the project life formula? Sensitivity percentage is equal to useful life minus discounted payback period divided by useful life. You need to know one thing: discounted payback period is the time period where NPV is zero. Discounted payback is the time period where NPV is zero. So sensitivity percentage. I'm assuming that the useful life is, let's say, 10 years minus the discounted payback. Assuming the discounted payback is 6 years divided by 10 into 100, it becomes 40%. If you just use the formula, you will get 40%. It means if useful life reduces by 40%, then NPV will become zero. NPV will become zero. Obviously, if the useful life is 10 years and if it reduces by 40%, it will become 6. And as I mentioned just right now, discounted payback is the time period where NPV is zero. Discounted payback is the time period where NPV is zero. So dearest students, one, you have to memorize all these limitations as well as formulae. So sensitivity analysis is simply the name of a technique which gives you the information how much adverse change in estimate will make NPV zero. Logically, the lower the change which makes NPV zero project is more riskier on that variable. As one more thing I've just mentioned, if your net present value is after tax, then all the denominators will also be after tax. If your net present value is after tax, then all the variable will also be after tax. Okay, dearest students, this is all about sensitivity analysis. Inshallah, in the next class, what are we going to do? In the next class, we'll be practicing sensitivity analysis. And second, after practicing sensitivity analysis, we will start another topic from the remaining topics. So in the next class, one, we'll be doing the practice of sensitivity analysis, and second, we'll start a new topic from the remaining topic, because after sensitivity analysis, still we have 3 topics to be covered in the area of investment appraisal. So thank you very much for watching this lecture. Have a nice life. Okay, students, in this handout, small, I would say handout, we will be discussing question on sensitivity analysis as well as payback period. Number 1, are the following statements true or false? The sensitivity of a project variable can be calculated by dividing project's NPV by the present value of cash flows relating to that project variable. True. For example, if we are performing sensitivity analysis on selling price, what are you going to do? NPV divided by present value of sales. And obviously we have discussed if NPV is after tax, then the denominator will also be after tax. So simply, if you are performing sensitivity analysis on a selling price, you will be dividing the NPV with the present value of sales. The expected NPV is the value expected to occur if an investment project with several possible outcome is undertaken once. Incorrect. Expected value of NPV can occur if investment project with several possible outcome is undertaken many times. If you take it many times, then there is a possibility that you will have at least one time you will get the same result. But if you are doing the same activity many times, then expected value may occur. Otherwise, it will not occur in once. So the statement 2 is incorrect. The discounted payback period is the time taken for the cumulative net present value to change from negative to positive. True. Logically, discounted payback, even a simple payback, is a time period where you actually start getting the is the time period when your negative cash flows they become positive. So statement 3 is correct. What is the expected value of NPV of the investment project? Basically, dear students, in expected value, all you need is just multiply the cash flow with a relevant probability. So there's no need to go for in too much detail. If the question comes on expected values, probabilities will be given to you. All you need is just multiply the relevant probabilities with the relevant cash flow. What is the expected value of NPV? An investment project has a cost of 12,000, that is initial investment, payable at the start of the first year of the operation. The possible future cash flows arising from the investment project have the following present values and associated probabilities. Look at this, 16,000. That is present value of year 1 cash flow into 0.15 plus 12,000 into 0.6 minus 4,000 into 0.25. In the second year, we have 20,000 into 0.75 plus we have negative, in fact, 2,000 into 0.25. Whatever comes, deduct the initial investment, which is 12,000. We are getting the result 11,100. So simply all the respective probabilities and the relevant cash flows and simply deduct the initial investment. If I write here 16,000 into 0.15, 12,000 into 0.6 minus 4,000 into 0.25 plus 20,000 into 0.75 minus 2,000 into 0.25 and then less the initial investment. This is how we get expected value of NPV. Okay. SAC company has a cost of capital 8%. Appraising project Gamma. It has the following cash flows. The investment is 1 lakh. Net cash inflow is 40,000 from T1 till T5. It means annuity is given. What is the adjusted payback period for? Adjusted means discounted payback. Adjusted payback means discounted payback. Obviously, annuity cash flow is given to us, but since we need to calculate adjusted payback period, discounted payback period, so the shortcut initial investment divided by the annuity cash flow is not applicable. Initial investment divided by the annuity cash flow is only applicable when you are calculating simple payback and you have been given annuity cash flows. In case of discounted cash flows, I cannot use the shortcut, which is initial investment divided by payback. So we have to solve it properly. So let's try then. Cost of capital is 8% and the initial investment is 1 lakh. Time T0, T1, T2, T3, T4 and T5. Cash flows. T0, we have 1 lakh. 40,000, 40,000, 40, 40 and 40. Discount factor is 8%. Let's see what is the discount rate for the first year. It is 0.926. It is 0.857. 794. 735. 680. Present values. Obviously 100,000 negative. 40,000 into 0.926. I'm getting a present value 37,040. Then 40,000 into 0.857. I'm getting 34,280. 40,000 into 0.794. 31,760. 40,000 into 0.735. 29,400. 40,000 into 0.680. 27,200. Now we will have cumulative cash flows. Obviously at time 0 it is 100,000. The initial investment is 100,000 and let's say we have recovered 37,040. If I deduct 37,040, we have invested, let's say 1 lakh and we have recovered 37,040. So how much is left? Still we need to recover 62,960. Then we recovered further 34,280. So I'm getting 28,680. Obviously, before the end of third year, we will recover the entire initial investment. Because in the third year, we just need to recover at least more 28,680, and in the entire third year, we are getting 31,760. We're getting more than 28,680. So definitely before the end of third year, or near to end of third year, we will recover 28,680. So what is the payback period? It will take 2 years plus 28,680 divided by 31,760. 31,760. It is coming almost 2.9 years. 2.9 years. If you do not get the exact answer, then go to the closest one. Just under 3 years. Our project is the following cash flows. Okay. Time 0, the investment is 1,10,000. Net cash inflows, again the annuity. At the company's cost of capital is 10%, NPV is 16,800. Already they have given us one cost of capital and they have given us NPV as well. Applying sensitivity analysis to the cost of capital. Basically, when you apply sensitivity analysis on cost of capital, first you need to know the formula. Sensitivity percentage is equal to IRR minus cost of capital divided by cost of capital, obviously into 100. So when we apply cost sensitivity analysis on IRR, cost of capital. So this is the formula: IRR minus cost of capital divided by cost of capital into 100. They're asking what is the percentage change in the cost of capital would cause the project NPV to fall to 0. So simply we need to calculate IRR. Once we have calculated IRR, then simply use the formula. IRR minus cost of capital divided by cost of capital. And we know that we can very easily calculate IRR by using the shortcut function which is available on the spreadsheet. So let's take the benefit of that, because now there's no need to use a formula of IRR since the shortcut is available. So whatever shortcut is available, you are supposed to use those shortcuts. So IRR shortcut is available in financial management, and obviously it is also available in AFM. So let us go to the Excel. Initial investment is 1,10,000. Initial investment is, let me share this. Okay, initial investment is, we know that 1,10,000 and the cash flow is 40 years and the time period is 5, I believe. Let me check. It's 4. Time period is 4 years. Okay. It is 0, 1, 2, 3, and 4. All you need is just simply write the net cash flows. It is obviously negative 1,10,000. Then we have 40,000 each year. Now simply calculate IRR. Just a minute. IRR. Just take all the values. So IRR is 17% and the cost of capital is 10. So sensitivity percentage. 17 minus minus 10 bracket close and simply divided by 10. We're getting 0.7 means the percentage is 70. So if the cost of capital changes by 70%, if the cost of capital changes by 70%, then obviously NPV becomes 0. So let me share the OneNote now. So logically the answer is 1 alpha. So if there's a percentage change in the cost of capital, if cost of capital changes by 70%, then NPV becomes 0. A company has calculated the NPV of a new project. Present values, sales, variable cost, fixed cost. Okay, NPV is this. What is the sensitivity of the project decision to change in the sales volume? And it came the way back in 2018. So simply we need to apply sensitivity analysis on sales volume. The formula is NPV divided by present value of contribution. And we know that if NPV is after tax, then your denominator has to be after tax. And in this question, we can see the tax as well. So simply let's apply the sensitivity. So NPV is 200. We know that contribution means sales minus variable cost. The contribution is 2,000. Because from sales of 4,000, if I deduct the variable cost of 2,000, so definitely I'll get a contribution of 2,000. Tax rate is 20%. If I apply 20% tax rate on the contribution 2,000, it becomes 400. So if I deduct 400, so I'll get after tax contribution 1,600. Or you can do one more thing. Just take the contribution 2,000. Your tax rate is 20%. You can multiply this 2,000 with 80%. It's the same thing. You will get 1,600. So if someone deducts 20% of from 2,000, or someone multiplies 2,000 with 80%, it's the same thing. Your contribution becomes after tax. Let me use the calculator. 200 divided by 16, and it is coming 12.5%. That's it. So, dear students, now let me quickly tell you what are the remaining topics in investment appraisal. The remaining topics in investment appraisal, one is asset replacement decision. Second, one is asset replacement decision. Second is lease or buy decision. Third one is capital rationing. So, dear students, these are the three remaining topics in investment appraisal. Inshallah, after completing these three topics, obviously with the practice, heavy practice, after completing these three topics, inshallah, with obviously a lots and lots of practice, we will move to cost of capital. So that is all from my side. Thank you very much for listening this lecture. Have a nice life.